My name is James Harries. I'm the manager of the STS Global Income and Growth Trust. I stand before you as a defensive manager in a defensive house during a rip-roaring bull market led by technology. That is not a comfortable position to be in sometimes. But let me give you some background to how we're investing, some hope for what we might think happen in the future, and at least a description of how it is that we're approaching global income investing at Troy. So we try to invest in portfolios and businesses that we consider to be exceptional, resilient businesses. I think Sebastian's given you a good kind of idea of that. Now that exceptionality and what makes businesses special is really inherent in the returns on capital which they generate. But also we like them to be resilient. Now that resiliency currently, you could argue, is being somewhat underappreciated, given that there are many that are chasing perhaps the latest fad, to use Sebastian's expression. We want businesses that may not be the fastest grower, but will grow persistently and resiliently. Now, they have not been the strongest performers recently. We go on to see our recent performance has not been good, for which we are sorry. But we think that that resiliency, if Sebastian's right, and if our view of the world comes true, then that might be much more valuable in the future than it has been in the recent past. We want to grow the dividend backed by genuine cash flow. That has two implications, that we are covering our dividend with cash. We're not distributing capital. And it also means that the businesses in which we invest, generally speaking, have limited capital requirements. That enables them both to invest in their business, to entrench their competitive advantages, but also to pay a dividend. Now, of course, the split between income and capital goes back to the times of the Crusades. It's not a new concept. But it is sometimes easy to forget when markets are rising very quickly that maybe spending a bit of capital is not such a bad thing. Well, sometimes it isn't such a bad thing, but when times are tough, if you're not covering at least some of your expenditure with income, then it means you have to dip into your capital at times of trouble. And that's why income investing, in my view at least, I know I'm biased, in my view at least, will always have some place in people's portfolios, particularly, if I may say, for those who have irreplaceable capital. And that often happens, of course, in retirement. And finally, we want to produce above average returns relative to our peers with below average volatility. Now, we think both of those things matter. And actually, until recently, over the last 17 or 18 years, I've been managing money on this basis, we have achieved that. But recent performance has been challenging, as we've seen the market run away from us. But we're confident that we can get it back, particularly over a full market cycle, whenever that might be, and we'll talk about the cycle in a second. So both returns, but also limited volatility, because the reality is, when you're young, volatility is your friend, in lots of ways probably, but particularly in investment. Because if things fall off dramatically, you've got plenty of time for things to recover. When you're not so young, that isn't the case. And avoiding steep drawdowns, as Sebastian so clearly demonstrated, can be very valuable and allows you to compound capital in a more persistent manner. Why do we think that's particularly important today? Because we have to remind ourselves that markets have only been more expensive in the US a couple of times in history. 2021, 1929, 2000 arguably. On different measures, you can measure it slightly differently, but suffice to say, pretty much on every measure, long-term that is, US markets are as expensive as they've ever been, and therefore potentially not chasing the current what's going up so quickly. In the next 6, 12, 18, 2 years may not be such a stupid thing to do, because this tells you very little about what markets are going to do in the short term, but it gives you quite a robust framework for what returns are likely to be on the longer term. When valuations are where they are today, returns are likely to be low. And we think, therefore, that you might want a portfolio that looks quite different to the index, coming back to Sebastian's point about concentration, for at least a proportion of your assets. So I mentioned performance has been challenging. You can see that actually it's slightly frustrating. As recently as August 2022, we were top of the pops, particularly on a risk-adjusted basis. But more recently, markets have run away from us somewhat. And it's been led particularly by companies relating to AI, or artificial intelligence. And again, we'll talk a bit more about that in the future. But once again, we're trying to produce excellent risk-adjusted returns over a full market cycle. And we think that that will be something that we are able to achieve whenever that cycle may happen. Why? Well, largely because of this. Because when difficult times come, Troy tends to produce better, loses less money. And over time, you tend to underperform quite long periods, sharply outperform, underperform for sharply outperform, and you produce very good long-term risk-adjusted returns. Now, it may be a bit too early to pencil in the 2024-25 recession. I mean, did I say that? No. I mean, it may be a bit early to say that the slowdown that may be coming, we can't yet put on the chart. But it's a distinct possibility, we think, still, that the rise in interest rates could at some point create an economic slowdown, and I'll talk a bit more about that. So what do we own? Well, Sebastian mentioned staples. We do like consumer staples businesses. We like their resiliency. We like their predictability. We like their brands. People have been writing brands off since the early 90s, but actually they have enormous power. We like their distribution power. We like the fact that replicating those businesses is actually a very, very difficult thing to do. It takes a long time. And we have a number of branded consumer goods businesses in the portfolio. They also demonstrated in post-COVID that they've got pricing power. And that could be a very valuable attribute in a world where it may well be that inflation's a bit higher than it has been in the past. We've got a number of platform businesses. CME Group is a Chicago Mercantile Exchange. It has the 5 biggest futures contracts in the world. As people want to hedge interest rate risk, inflation volatility, commodity volatility, the CME is wonderfully positioned. IHG is a hotel and branding company. It's recovering nicely post-COVID as people want to travel. Nintendo is a business we love. They're probably going to launch the next console this year or potentially beginning of next year. And we think that the transfer of the current gamers who have an individual account with Nintendo onto the new console will be something that gives the market great confidence. We have a number of enterprise businesses, a number of software businesses, particularly related to enterprise. And we've got a group of what we put as historically dependable income, which are a number of different businesses, but the main feature being that they have really dependable yield. So these form the bedrock of the portfolio, if you like. You'll notice that some of the current AI beneficiaries aren't there, but we think over the longer term, these are a sensible place to compound capital. We also think that if we do get a sell-off, there are 3 key areas where we would like to add more risk, if you like. We think that in that way, by trying to balance income, quality, and growth, we'll be able to maintain the quality of the portfolio, but increase the growth critically without compromising on income. And the 3 areas where we think that might be possible are industrials. We have a number of really high-quality industrial businesses around the world that we'd love to own, which are super expensive, though, currently. In fact, the most recent sell in the fund was a company called Fastenal. This is a business we love, Tomasz and I, who helps manage the fund. It distributes nuts and bolts in the States. It's a wonderful business. Doesn't sound particularly interesting, but it's a wonderful business. It was on 38 times. 38 times for that sort of business is too much, so we think that we need to be patient. The consumer, it's no surprise the consumer, or no secret that the consumer is under somewhat of a cloud at the moment. The cost of living crisis is real. Without sounding too much like a heartless fund manager, we do think that might give us an opportunity to invest in consumer-related businesses. We've put a handbag here. I know LVMH sometimes isn't considered a consumer company, but because it's luxury, but we would say ultimately that it probably is. We would like to own that at some point if we get a better opportunity to buy it, but other consumer businesses as well. And finally, non-bank financials. We put a competitor, BlackRock. We would like to own high-quality businesses, but when valuations and activity in capital markets themselves is better value. And that will give us an opportunity to buy a business that's got higher returns, faster growing, better shareholder returns, but that is geared into capital markets. Now, the problem with this, of course, is that each of these, industrials, consumer, and financials, they each have a degree of cyclicality attached to them. Industrial cyclicality, consumer cyclicality, financial cyclicality, you might call it. And therefore, we think we need to be patient before taking on more risk in the portfolio when we are rewarded, a bit like personal assets trust. What we have done since we took on the trust is growing the income consistently. You can see we've grown it by 4.7% per annum. Thank you for the decisions of the board who've been making the dividend decisions. And we would hope to continue to be able to grow the income persistently through time. Now, if you squint, I know the numbers they're better up there. You can see we've got about 31% in the UK currently. That's actually the highest weighting in the UK on a listed basis that we've ever had in all the time we've been managing global income money, which is now quite a long time. Why? Well, because you all know that the UK looks relatively inexpensive. Now, you can argue about the composition of the index, and there are lots of businesses that tend to trade at lower valuations than other markets. But actually, we perceive some really high-quality global businesses in the UK to be really good value. And they're perfect, therefore, for us as a global income asset. But we do also point out that on an underlying revenue basis, and this is how we think you should think about it, it's much more important where a business makes money than it is where it's listed. We have relatively limited exposure to the UK. And we have a global portfolio. So half the portfolio in the US, 25% or so in Asia and emerging markets. And therefore, it's a global portfolio. Now, I mentioned that recent performance hasn't been great, but we have some reasons to believe that it might improve. Can't promise it, obviously, but we think there are some reasons why we think from here things might pick up in the trust relative to perhaps the market. The first is the cycle. We've shown here a bit of a roller coaster. That's intentional because it strikes us, and it's rather remarkable in many respects. We haven't actually had an orthodox economic cycle that is, for 25 years. The global financial crisis was about banking and housing in the States. COVID was COVID. But outside that, we haven't really had a normal economic cycle. We haven't had a cycle whereby you have a bit too much inflation, which means the authorities have to put up interest rates, which means that we get a slowdown, which means that we have a credit cycle, which means we then move on to the next. That hasn't happened. And we think it's still perfectly possible, given that interest rates have gone where they are, where they've been to where they are, that slowdown still may occur. If that does occur, that might well give us an opportunity. So, it's usually 18 months to 2 years after the last interest rate hike before you see the genuine slowdown. We're still comfortably within that band. I'm not predicting recession, I'm just saying it's still highly possible. And we will be ready to take advantage of it should that happen. So if that was to happen, then perhaps you would see the kind of companies, the resilient, exceptional businesses we own, perform a lot better, maybe on an absolute basis, but definitely on a relative basis. The second point is the poor old UK, which has been in the capital markets doghouse. We think that may be changing. We know that the UK has been deeply out of favour for all the reasons we could discuss, all the reasons we could talk about. But who knows, maybe things are changing. And it does seem that we've seen a lot of mergers and acquisitions in the UK begin to come through. We've seen general sentiment to the UK market begin to improve. And this is at a time when it looks, we think, very good value. Finally, and I apologise for this, Sebastian said you may remember Mr. Larry Hagman. You may also remember Monsieur Creosote, who famously, if he ate another wafer, would explode. What we're talking about here is GLP-1 drugs, these weight loss drugs. As I'm sure you're all familiar, these originally were created for diabetics, and it turned out they allowed people to lose weight as well in an amazingly predictable way. Now, don't get me wrong. For people who have comorbidities associated with obesity, being able to take these drugs and lose weight is going to be a fantastic thing. And actually, we do think that it may well be that the adoption of these is probably going to be pretty widespread. What we question, however, is the extent to which consumer human behavior forever and globally is going to be forever changed by the adoption of these drugs. Now, the reason I bring this up is consumer staples particularly suffered, particularly last year, as a result of the GLP-1 phenomena, if you like. And yet it strikes us that those companies have begun to recover. They did look very good value. In fact, the most recent purchase in the fund is Pernod, which we think is a wonderful business. It's effectively all about selling whiskey to people in India and cognac to people in China. I think long-term that's going to be a great business. And so we think that the GLP-1 scare may be in the rearview mirror and these sort of companies can recover. And then finally, we get to good old NVIDIA. We had to mention it at some point. This chart shows you the share price of NVIDIA relative to the UK, the French, and the German markets. Isn't that remarkable? NVIDIA is now trading on something like 40 times sales, which is double the next most expensive company in the S&P. And yet, until a couple of days ago, of course, it's down 15%. Since the top, it was the largest and the most expensive company in the S&P. Let me say that again. It's the largest and the most expensive company in the S&P. Now, it strikes us there's both a macro and a micro reason to perhaps think about not chasing such things, particularly in a global income context. Obviously, it doesn't yield, but it's kind of demonstrative of where we are. At the macro level, Sebastian mentioned that the concentration of the US market is extremely high, and this can cause, means you're taking on more risk effectively. Now, going back to 2000, it's easy to forget that Troy was effectively founded on not chasing the very large capitalized companies. Because if you go back to that time, Vodafone was 10%, going over 10% of the UK market. And people were changing the ways in which they're allowed to invest in their fund to be able to accommodate Vodafone and so on and so forth. Troy put a limit on the amount of money they could have in any one company in order to avoid that concentration risk, and indeed had limited equity exposure. It's easy to forget how difficult that must have been in that sort of context. Now, I would say to you, we've got NVIDIA that's now over 100% of the UK market. Vodafone's 10%. NVIDIA's over 100%. And therefore, it may be that having a portfolio that doesn't look particularly like that may be of interest. And reminds you that That's effectively what Troy is for. It's not to chase fads. It's not to get caught up in very highly valued, very popular companies, but to be perhaps a bit more dull and a bit more worthy and to grind out dependable returns which can deliver in more difficult times. And why? Well, because we think we are generating still a pretty decent free cash flow yield. So the portfolio as a whole is generating 5.5% free cash flow yield, and I showed you that the dividends in the portfolio have grown at approximately 5%. Now, one way of thinking about returns in a portfolio is take the free cash flow yield plus the growth in the free cash flow yield, and on a forward expected return basis gives you an idea of what you might generate. So if we're generating a 5.5% free cash flow yield, which you can see on the right-hand side as we look at it, is supported by a really high-quality portfolio, which is compounding capital at an underlying rate in a persistent manner, well, then it's not unreasonable to expect a high single-digit, low double-digit return from a portfolio like this. Delivered 3% in terms of income, so you can cover your day-to-day bills, or at least some of them, and 6 or 7% capital growth, which, for those mathematicians amongst you, will double your capital every 6 or 7 years, rather the rule of 72. Now, given everything that Sebastian and I have said about the backdrop, given everything we've said about valuations, given everything we've said about the concentration in markets currently, if we can deliver that kind of return in a persistent way, then perhaps that might not be such a unsound place to be allocating some of your capital. That's why we're investing as we are. That's why we can look to the future with confidence despite the recent dull, lackluster performance. While the market's been going up, we've been going sideways. So ultimately, we want to be seen as the high quality, and by that we mean the underlying businesses in which we invest have persistently high returns on capital for identifiable reasons, low volatility, and I've mentioned why we think that's important, trust in the sector. So finally, I couldn't resist putting in what we think we might be. This, to the uninitiated, is a Suzuki Jimny. This is close to my heart, not just because I own one, because this is a very resilient vehicle. And on some measures, and I'm sorry, Sebastian, it actually outperforms the Land Rover off-road. So I admit it's a bit smaller, as we are relative to Pat, but you might expect some decent performance in a more difficult time. So thank you very much, everybody, for listening to me. I'm now going to hand back to Francis.